Today, we will be looking at a financial planning case study of the Peters family. My objective in recording this video is twofold. Firstly, I want to showcase how I, the financial planner, think about financial planning for a couple who are in the mid to late 40s, high earners, high net worth individuals. The second objective is how you, the client, might see the plan. When I present a plan to my clients, what is their experience like? So we will be considering both perspectives in this video. Before we jump in, a note about this family. This profile is a fictitious client profile. The data, however, is based on real data with some modifications, change of addresses, change of names to make sure privacy is maintained, and some modifications. So let's move forward and first introduce the Peters family to you. As mentioned, there's a family of four, Jake and Joanna, who are 47 and 48. Jake is a scientist at Calico Life Sciences. Joanna is a hardware engineer at Apple. They have two kids, Kelly and Kevin, 13 and 10. They live in Foster City, which is in the San Francisco Bay Area. Jake's parents are independent and healthy. They're financially quite comfortable and live in the Marin County, whereas Joanna's mom is single and she has some health issues and she lives in Arizona. And part of the financial planning um, engagement focuses on how they could potentially move her to the San Francisco Bay Area where she can be closer to both her children. Joanna's brother is also based in the San Francisco Bay Area. At a high level, the assets about 4.8 million, 4.75 million, couple of properties, a starter home that they moved out of but never sold, and then their current single family residence, both in Foster City, and about 2.35 in invested assets, 1.15 in taxable, and a large amount in qualified accounts, which are basically retirement and HSA and so on. They have about 500K in liabilities. When it comes to income and savings, the picture is fairly typical for the Bay Area. Um, High income, considering that both of them are employed, Joanna in high tech. She brings in the majority of the income, 500 out of nearly 700K, and this is something that we will navigate through this plan as well. And then they get a very little through self-employment and net rental income. Their savings rate is pretty good, nearly 200,000. They max out their 401k and HSAs. They don't sell their RSUs, and whatever is left at the end of the day, end of the month, they invest it in their taxable accounts. They have annual expenses of about 185,000, and that includes all the housing related expense as well as living expenses. And they definitely want to set aside a sum for travel, make sure that they're creating those memories when the kids are young and the family is able to travel. When a new client comes to me, one of the first things I sit down and try to discuss at length is understand their life goals. It really helps for me as a planner if I understand my client's goals, aspirations, dreams, fears really well. In this case, Jake and Joanna, they want to retire no later than 60. That's basically when the kids are out of home, finish their college. They feel like that's the time for them to retire and at their current lifestyle. Joanna wants to explore retiring earlier than 60 and working on her side gig as a yoga instructor. She's been doing this as sub teacher. She's working towards her teacher certification, but she really wants to take this to the next step. Moving on, they want to sponsor their children's undergrad. A note here that Jake's parents have offered to sponsor complete education for their grandkids. So this is not a high priority item for them, but they want to make sure that the kids absolutely they don't take out any loans in the undergrad. Another big item is Joanna wants to relocate her mom from Arizona to be close to her so that she can take care of her. She needs she has some health issues and she needs attention and support on a consistent basis. When it comes to legacy, they don't have any specific plans. They know that there might be some inheritance coming from Jake's parents, so they're not too worried about leaving a lot of their money to the kids. They think it'll happen. So they, however, want to be for their kids if they want to buy a home or they want to start up a business. So they want to support them if the need arises. So with life goals, the next set of things I want to focus on is what are the financial planning goals? Why did they come to see me as a financial advisor? First, they want to know where they stand with respect to retirement. They're 48 and 47. They want to retire in about 12 years or so. They want to see how they're tracking. Are they saving enough? Are they saving in the right vehicles? Those are the questions they have. They want to explore retirement scenarios for Joanna without jeopardizing their financial well-being. This is really important, and this tends to be a point of disagreement between Jake and Joanna. Joanna is the high earner. She really brings in 500,000 out of 700,000 family income. So there is a discrepancy. And Jake, who's more conservative of the two, feels like if Joanna were to retire early, they would be jeopardizing their financial well-being. And Joanna, on the other hand, feels like, hey, she has a side gig that she's really excited about. She's not really liking her job anymore. So she sees using her time to do things that she really gets joy out of, joy and meaning and purpose. So there is this a little bit of tension, and this is something that we routinely navigate. When a couple comes, the one of them tends to be in a different place when it comes to risk tolerance or appetite for saving, and this is something we have to navigate. Here, the couple have agreed that Joanna can retire early, provided she does not. In doing so, they don't jeopardize the financial well-being. I think this is a great kind of place to start. The other things they want to do is make sure that their savings and investments are optimized, streamlined, easy to manage. Definitely make it more tax efficient. They are in the high tax bracket, and they want to make sure that they're paying no more than they should in taxes. And they want to help relocate Joanna's mom to San Francisco Bay Area. So these are the high level planning goals that they've come to me with. With this, let's jump into seeing what their plan looks like. Now here, this is a popular software, Right Capital. I use this for planning for my clients. This forms the basis for my plan. Not everything is done on this, but this is a good tool to get a 360 view, a high level view of what's happening. So let's jump into this. At the start of an engagement, I typically ask for assets, liabilities, income situation. All this data needs to be transferred over to the planning software. One of the first things I do when I've completed that is to run it by the client to make sure that I've accurately and faithfully captured everything and input into the software, right? So we're going to do that now through examining the balance sheet. So balance sheet is basically a list of assets and all the liabilities. We can see here they have about 100,000 in cash for emergencies, for the daily spending, and then they have about 2.3 million in total invested assets. There's qualified assets, which are basically 401ks, IRAs, 529, HSA, and then there is the ordinary taxable brokerage accounts. As you can see, they have Apple stock from Joanna's employer, and they also have a joint brokerage account. When it comes to their real assets, they have a primary home and a condo. Um, and then they have liabilities. They have mortgages on both of these properties, about 400,000 on their primary home and about 100,000 on the condo. So all this sums up to about 4.8 million in net worth. Once I get a green light, like everything looks okay, then the next thing to look at is basically their goals. When it comes to the goals, let's click on this and see where they stand. So these are the goals that the couple is aspiring to. Retire no later than 60. We'll talk about the healthcare costs in retirement later. Right now, we are not planning for retirement for them. So these are of less importance. These are placeholders, and we'll let them be there for now. Retirement expense of about 10,000, which is what they spend today on their living expenses. Um, Legacy, we've put in a goal of 1 million just to help the kids, with down payments, whatnot. As I said, they're not super keen on this, or this is a low priority item for them, so it's okay to leave it as this. Um, they want to put their kids to education, college. The 4-year college costs about 46,000 here in California in today's dollars, and this will be inflated to um, uh, inflated the right amount by the time they actually go to college. Family vacation of about 10,000 per year. They usually the Peters family goes to nice locations in summer and enjoys the vacation, creating memories. So this is something really important for them. So they want to market separately. Also things like cars, like you'll probably need to change a car once in 10 years or so. So we've given them allowance. And finally, um, we spoke a little bit about Joanna's side gig right now as a yoga teacher. She really wants to create a yoga studio in their two-car garage, which is currently barely used. And she wants to take private lessons there, maybe create like some kind of a studio. So they estimate about 50,000 in today's dollars to convert the garage into a studio. So these are the goals at a high level. Now let's talk about quickly about income. Um, Jake's salary is about 165,000. Joanna's base salary is about 270. In addition, Joanna gets a 15% bonus. Jake's bonus is 10%. And very importantly, Joanna also gets a healthy amount of stocks through RSU grants. That's something that we will see when we look at the cash flow. When it comes to savings, they max out their 401ks and HSA. All these other items, backdoor Roths, I've kept it to zero. They're here for a very specific reason that we will explain in a bit. When it comes to expenses, they spend about $10,000, not including housing. Housing is a separate bucket. And then when they retire early at 60, between ages 60 and 65, when they actually are going to be qualified, covered by Medicare, they need early retirement healthcare insurance, which they have to buy on a marketplace like ACA. We've allocated $1,500 in today's dollars for that. A different way to look at the same thing is by like pictorially. You can see all their assets that is jointly held as well as separately held. And then we see the goals. You can see that Kelly will start her college in 2029 and Kevin in 2032. And yoga studio in when Joanna is 55 in 2031 and so on. And the plan runs till about their 90 and 92. And similarly, we see pictorially their income situation. All right, with all this, now we are ready to look into plan. However, before going into the plan, I always present the assumptions that we need to make as financial planners. So there are certain assumptions on what the stocks might return over the next 10, 20 years. We use standard assumptions that are well researched by JP Morgan for this purpose. And then we also have to make assumptions on taxes, whether there will be a tax cut in the future or not, what will the tax rate grow at, and other assumptions, most importantly, around inflation. So here we've assumed a global general inflation of about 3% and healthcare and education inflation at about 5%. This is fairly standard. So these are all the assumptions that we need to make when we are planning. And this is something that I always run by clients to let them know that, like, hey, this is an important part that is not obvious, and we can always change it for you if you feel strongly about it. For now, we'll go with these assumptions and let's jump into what my take on the situation is. Given now I have a full view of their goals, of their cash flow, of their income and expenses, assets, here are some things that stand out for me from their profile. Um, Before that, let's just quickly look into cash flow. This basically shows where the money is coming from and where is it going. As you can see, they have a healthy amount of income in salary and stocks. The 220,000 is RSU grants for Joanna. And the expenses are broken down into living expenses, housing, what they pay for maintaining their condo, taxes. We'll look at this a little more in detail, and their savings. Their saving is about, as you can see, close to $250,000, a little north of what they had estimated in 2000 as it's $200, $200,000. So they have a very good savings rate. Their savings rate is north of 33%. That's excellent. So that's really good, going well for them. And as I mentioned, they're not in the highest tax bracket, but they are about. They're currently in 35% tax bracket, and they tend to be in high tax brackets. This is a common situation here out in the Bay Area. People are in the higher and the highest tax brackets, and when it comes to planning for them, we need to be make sure that everything that we are suggesting is tax efficient and minimizes their lifetime taxes as well. All right. Having said this, let's start looking at some of the scenarios for them, what I've created based on what they've said, where they want to plan. Um, a quick note about these numbers. Um, they have these numbers here are basically what we're going to use as the North Star for guiding us through the plan. Firstly, this number here, the percentage, means that when you have run multiple simulations of their retirement through the years, if they run it 1,000 times, about 82% of the times you're okay. You don't run out of money. And about 18% of the times you do run out of the money. And this does not mean that they actually run out of money. It just means that they might have to make some changes, either save more, work longer. They might have to do something to, not be in the situation. Um, so as a planner, I shoot for about 80 to 85%. That's a sweet spot. Anything above 85, you start looking at maybe leaving too much money and kind of not spending, on yourself, which you deserve in your retirement. And anything 75 or below, you might have to think about either working for longer or cutting your expenses, something of that sort. So the sweet spot is about 80 to 85. 85 is pretty good. And you can see, the current plan, if they were to work until 60 with all the assumptions on the returns and expenses, they are at 86%. This is pretty good. And this number here on the green graph is the median assets that they would leave behind at the end of their plan, which means that when they are no more, their estate would be 5.8 million in today's dollars. It's not in it's inflation adjusted. So if everything were to continue as is, as the current plan is, at the end of their lives, they would leave behind about $5.8 million in invested assets. In addition, there would be the real estate as well. So this is what these numbers mean. We're not taking these literally, but we're using this to guide us. This will be our North Star. This, along with the cash flow that we just saw, will be the guiding post for our planning. When we make decisions, we want to make sure that they're comfortable on cash flow, that they're not jeopardizing their retirement. All right. Now that we're here, my take on the Peters family. First, let's look at their investments. I want to look at their concentration. Now, Joanna has been working at Apple for a few years, and she hasn't been selling the stocks that that vest, the RSUs that vest. As a result, they're sitting on about 28% of their net invested assets being in Apple. This is a little too high for my comfort. We hope and shoot for 5 to 10%, no more, of invested assets being in a single stock. This is a little too much. It exposes them to volatility, company risk, and a whole lot of other issues. So definitely you want to bring this under control, and we will come up with ideas on how to reduce their concentration risk in Apple. So this is the first thing that jumps out at me. The next thing is when I look at the tax allocation of the current investments, I see that only 6.8%, only 6.8% is in tax-free assets. And that includes their 529 plans as well, which technically is not theirs. It'll be for the kids. So they have very low amount in tax-free assets. Now, going into retirement, you want a healthy mixture of tax deferred, which is your 401ks, and your IRAs, which is in the orange color. You want a healthy amount in your tax free and a good amount in your tax free bucket as well. So this is a little skewed towards taxable and tax deferred. I would like to see this number higher. So some of my recommendations will be based on this. Moving on, the next thing is when I look at their asset allocation for certain accounts, for example, the HSAs, they're sitting on cash. It's not invested. Now, if you have an HSA and it's sitting on cash, it's not working for you. You want to invest it in the market, especially when you have good cash flow outside of it so that you can pay for your medical expenses out of pocket and let this grow. If it grows for 15, 20 years from now, it'll be a sizable amount. Then they can use that for medical expenses in their retirement or towards Medicare premiums. So it's good to be fully invested. And there are other small things here that I'd like to point out in when it comes to their taxable accounts. Let's quickly look at, okay, so they are sitting on a few stocks at a loss, like Zoom Communication, mRNA, Coinbase. So they are sitting on some of the losses. Now, an idea would be to sell these at loss, realize the loss, and then sell Apple, which they are sitting on a bunch of gain to offset those losses. So this is basically making use of your losses to diversify away from Apple. This is a good thing, and this will be one of my recommendations for them. They're also using these US bonds in their taxable accounts. Now, them being in the highest tax bracket and using holding taxable bonds in their taxable accounts is not a good idea. So they have some losses here. They can kind of harvest these losses and then move into tax-free bonds or muni bonds, which are much more tax-friendly for their taxable portfolio. So these are some high-level things in the investment bucket. Now let's talk about the real estate part of it. Now, if you look at the real estate, this is where I want to step back and say that a financial planning software can do a lot of things well, but it does not do everything well. For example, real estate analysis, pro forma analysis, it does not do very well. So for such situation, I jump into the spreadsheet, good old spreadsheet. I create custom spreadsheets for my clients to see where certain analysis of numbers or visuals which are not provided by the financial planning software. This is one such scenario. So they have a condo that they bought for 535,000 in 2007, and they moved out in 2013. So they've lost the opportunity to sell it and get the 500,000 capital gain exclusion. The section 121 exclusion is out of the is not on the table because they haven't been in the condo for 2 of the last 5 years. So that's out. The fair market value of the condo today is 900,000. They earn a monthly rent of 3,000. Now this is very low for the market rate in Foster City for a two bath condo. The going rate is about 4,500. Now this happens fairly commonly. When somebody manages their own property and they don't particularly like being landlords, they don't raise the rents. When they find a good tenant, they just keep them and they just keep increasing it by 50 or 100 bucks. They don't keep up with the market rate. This is exactly what's happened here. The market rate is 4,500, but they're renting it at 3,000 and they're just letting it coast. As a result, it's affecting the performance, the cash on cash return. We will see that shortly. So a gross rent of about 36,000 per year, annual property taxes 7,500, insurance, and HOA. HOA is about 500 per month. That's a lot of money that is going to HOA, which is eating into their profits. So a total annual expense of about 16,100 on a total rent value of 36,000. Now, when you move here and see the analysis, the returns, you see that they're spending 44% of their income on expenses. This is very high in my opinion. For good performing properties, it should be somewhere between 25 and 30%. The closer you get to 40 and above 40, that means that you're spending a lot on expenses that is essentially money not in your pocket. Similarly, cash flow after the mortgage payments is 2812. That is 3,000 in a year from a gross rent of 36,000. That's very poor cash flow. This is cash on cash when it comes to equity. The equity they have in their property is essentially the fair market value minus the loan. That's about 800,000. So they're getting a return of 2,800 on the equity of nearly 800,000. That's 0.65%. That is extremely low. If you are a real estate investor, you're looking at about 8, 9, 10% cash on cash return. This is very low. If they were to sell the property today, after accounting for selling sale costs, they would get about 846,000. They would have a gain of about 418,000, and they would owe a pretty sizable amount in federal taxes, about 100,000 in federal taxes on the sale plus the California state tax. And what they would have proceeds after the sale would be about 744,000. Now, if they were to invest this 744,000 and get just 0.38%, it would come up to the cash flow of 2,800. So you can see the bar is very low. Their condo is not performing very well. Another problem with the condo in this current market right now is that their values are falling. Since the pandemic, everybody is preferring a single family home with more space, yard space. That has just become the norm these days. Condos and townhomes are falling out of favor. So they're holding on to an asset that is not appreciating as well, and neither is it cash flowing very well. So one of my recommendations would be to either sell this or hike the rents, replace the tenants, or have the property manager kind of do that, because it's hard for busy couples, mom and pops, to kind of be on top of their rental properties, which is why some clients are better off with a property manager. Right. Now let's go back to the planning software and see how all this comes together. Excuse me. Yeah. So what we want to see is this on the right here is the current plan. If everything were to continue as it is today, their earnings, they're working up to 60, they're spending the same way. Of course, it's adjusted to inflation. And on the left side, we have a bunch of scenarios. We have a scenario. So what we are doing is side-by-side comparison of different scenarios. Right now, the proposed plan is the same as the current plan, so everything remains the same. And when you scroll down, you'll see all the levers we have to manipulate this. We can see the retirement age, we can change that, and we can see what happens. If we can see if Joanna's income goes up, goes low, what happens if we start saving in different vehicles. These are all the scenarios that you can play with to create a plan for your case, for your scenario. So let's walk through scenario by scenario for each of their things that they have brought up as they want to see. First, this is something that I mentioned. Their Roth savings, their tax-free savings is low, and I want them to address that. And this is how I propose that they address it. So the action items here are that I suggest that they invest in backdoor Roth IRA. They make both of them contribute to backdoor Roth IRA, and Joanna maximizes her after-tax 401k, which is basically offered by select employees. Apple is one of them. So I would definitely urge her to make use of that and maximize this. Um, and then you might be wondering, where does this money come from? Well, it would come by selling the RSUs that she's currently vesting. Now, this has a double benefit that it frees up the cash flow to contribute to these other vehicles, and she stops accumulating more Apple stock when they're already sitting on about 28% of Apple stock being their of their net assets. So this is a good thing. Sell your RSUs and invest in other vehicles. Now, what is the benefit of doing so? You can see right here, your median assets jumps up. Why does this happen? Because you take money from your taxable portion of your portfolio and put it into tax-free portfolio. So similarly, you can see here, if you look at the net taxes paid, increased Roth savings, that's the left-hand side, has about 313,000 less in total tax paid over lifetime. The total taxes paid less, increased assets at the time of at the end of the plan, both are great. So this is a no-brainer in my opinion for somebody in their situation with high cash flow. Use all these levers. Make sure that you're maximizing your tax-free buckets. That's number one. Next thing, Apple offers a fantastic ESPP program, Employee Stock Purchase Plan, where she gets a 15% discount on Apple stock with a favorable look back period of 6 months. Now, She is allowed to contribute up to 10% of her base salary towards this. I suggest that she maxes it out, 27,000. Now, this does not change it a lot, but it does change. So if you were to look at increased Roth plus ESPP versus increased Roth alone, you see that the number here is slightly higher as soon as it loads. There you go. So this is a good step. This is, again, you might be wondering, hey, but don't you think she'll be accumulating more Apple stock by investing in ESPP? Yes, but Apple is a stable company with 15% discount. It's a good deal. So I would go for this. And at the same time, divesting of the current holdings so that you're not accumulating more. So participate in ESP, don't hold on to your RSU grants, sell them as soon as they vest. That would be my recommendation. Let's go back to current plan on the right hand side, and on the left hand side we'll see what happens if they sell the condo. This is a great question, right? Because we saw that neither is it appreciating nor is it cash flowing very well. Look at what it does to their ending assets and the probability. Both go up. This is good. That's because they are giving up an asset that is not appreciating as much and putting it to stocks and bonds where it appreciates a lot more. Here, what I've modeled is that they sell the condo in 2025. Everything else remains equal. Just this change alone. We're not talking about Roth contributions or anything now. We're just talking about just one change at a time. We're comparing A versus B, A versus B. So current plan versus the condo sale. If everything else is equal, what does it do to the plan? It's a net win. I would suggest that they think about this. Yes, there will be taxes on the sale of the condo, and we can talk about what to do about that. There's 1031 options. There's other options. We can see there's installment sales. There's variety number of ways to do this, and we'll talk about it. But the net here is that they would be better off selling the condo, or alternatively, they need to increase the rents and or pull out the equity and invest the equity in a faster growing vehicle. This would be my recommendation. Now, moving on, early retirement. This one was one where Joanna wanted to retire early. So let's look a little bit closely at this scenario. If she were to retire at 55, her part-time yoga income would drop to zero, but she would be a full-time yoga teacher, earning 40,000 conservatively speaking. Conservatively speaking, um, you can see that there is a dip in the probability percentage, and more importantly, a meaningful dip in the ending net assets. Now, is this bad? Uh, no, it really depends on the perspective that you take. This by itself is pretty good overall. When you compare it to this, yeah, this is better, but this is not bad in and of itself. So this is where a couple has to navigate. What is more important is like my time, the freedom over my time, doing what is really meaningful to me more important, or having more assets is more important. But more importantly, as a planner, my job is to say, okay, how do you get to where you want with um, with giving up the least? So our next scenario is going to be focusing on that. For the first 3 or 4 scenarios that we focused, they all were meaningful increases in the final asset number as well as the probabilities, whereas early retirement took it a notch down. Now, what happens if we combine both of those? And what I do is put everything together. The increased Roth savings are there. The increased Roth savings are there. ESPP is a part of the plan. They're selling the condo, and the yoga income kicks in when Joanna is 55 and she gives up a job and she's 55. So you put everything together, and voila, we are within distance of where we were when we started out. This is a pretty much closer than the earlier scenario where Joanna was just giving up a job. Now you can see she's within striking distance. So the big takeaway for this couple is yes, it's doable. Joanna can retire early, and you won't be jeopardizing your retirement. Um, the couple also happened to share other things with me. Apparently, of the $10,000 of monthly spend, about 1,500 right now are for Kelly and Kevin's music and tennis lessons. So if the couple were to reduce this by to 8,500. Let's do that on the fly here. We see that they're even better off than they were where they were. Of course, they want to be conservative. They don't want to assume that they're going to be able to reduce their spending, because money has a way to spend itself. So let's go back to leaving it at 10,000. But all in all, this looks very promising. This looks very promising. Jake and Joanna have a lot to be hopeful here. There is a way for them to retire, for Joanna to retire at 55 and still not jeopardize their savings and their financial well-being. And there are a couple of things here that we didn't talk about specifically, about relocating Joanna's mom, about how to deal with concentrated stock positions. Those tend to be advanced planning, and I'm just going to give you a preview here. I'm not going to go jump into the depth of it. Firstly, the concentrated stock position, it's a very hairy problem. It's a good problem because your stocks have done well, but it's a problem that doesn't have any easy solutions. You're looking at either spending a lot in taxes to sell them, or you're looking at high fee products like exchange funds or charitable donations. There's a variety of ways to deal with this. The strategy we choose depends on multiple things: the level of concentration, the time horizon, the risk appetite. Do you have liquid funds right now? Um, all these, do you have the ability to sell? Some people are in concentrated stock positions not out of choice, but because they have a period of contingency where they cannot sell assets. So it depends on a variety of factors and what your goal is. Is your goal to diversify? Is it to hedge? Is it to get liquidity? So we're not going into the depth of it, but for now they can sell some things at loss, stop accumulating more RSUs, and start working that way. That's a high level suggestion. I will be working closely with a couple to make sure that we can actually get it down to an acceptable number like 10 or 12%. The other part is relocation of Joanna's mom to the SF Bay Area. Um, the couple and I spoke at length about the different scenarios and different ways that can happen. Obviously, the first thing is she can sell her property and come and rent here. But the problem is it has a very low basis. Her property in Arizona has low basis. If she sells, she has to realize all that gain. And if it's inheritance, in a decade or so, then, you know, why do it? Because at death, she will get us, the heirs will get a step up in basis. So that has its own cons. So selling property outright and coming here to the Bay Area and renting is not it has its cons. It's not the greatest option. Um, well, she can rent out the property there, and she can rent something here. That's a little more favorable. That's a little more amenable, because she probably can rent it out for about 2,800 over there, and she can make about, she can get a single bed condo here, or apartment for about the same money. So that's a viable option. She can potentially also rent Jake and Joanna's own condo, but again, this won't solve the problem of them holding on to an asset that is not performing that well. The other option is Jake and Joanna can sell their condo and buy her mom's property in Arizona, but then they'll end up being landlords, out-of-state landlords, and that's something that they don't want to do. So during this discussion, one of the things that I threw out was, how about converting their two-car garage into an ADU instead of a yoga studio? Now, this has several good things about it. One is that they will get passive income when Joanna's mom is no longer in the picture. Two, um, this is great because California is now permitting conversion of garage into ADU. This is a great option. Passive income, permitting is easier, and most importantly, having a business on your personal home is not a good idea for liability reasons. You want your business separate from your personal home, personal residence. There's a lot of things like insurance, liability, parking can be a problem. You don't want strangers coming, into your property like all the time. So there are multiple things. So this idea of creating an ADU and renting out a studio elsewhere fills a lot of gaps. And this is something that the couple is very keen about. And guess what? We are going to create a custom spreadsheet to see what is the return on investment for this scenario, where they add a ADU, they move in Joanna's mom there for 10 years or 12 years. She lives there. When she's no longer there, they can rent it out. And a single bedroom or a studio ADU will probably fetch in today's dollars about 28 to 2800 dollars. That's great passive income in their early retirement, and this I'm pretty sure will shoot this number up even more. So yeah, this is how we are thinking about this planning. And then very quickly, I want to give you a summary on what they see. Now, Jake and Joanna at the end of it will receive a lengthy report from Right Capital. It's literally 28 pages long. It has everything in there, and it tends to be very heavyweight. I often see that my clients don't even open this file, or even if they open, they just scan through it and it sits there. So what I do for them is create a very simple, high level plan of action. This does not boil the ocean. It talks about the key things that you need to do in the next 6 months to a year. Here are simple steps: rolling over IRAs so that you can do backdoors. Do backdoor Roth. This is how you do. It's a step by step, very clear what to do. We talk about the specific investments that they need to make, the specific asset allocation they need to follow, which funds to invest in, on which brokerage platforms. It's just a really simple, high level, do this now, and then come back in a year or two, we'll revisit. And in this case, Jake and Joanna are going to come back when they have more, they get a realtor's opinion on selling the condo. They'll probably go back and get an estimate on the ADU, garage conversion to ADU, and then we'll create some spreadsheets for them to walk through those scenarios. So this brings us to the conclusion of this video. I hope you've gotten to see how I think about planning for my clients and what they receive at the end of a planning engagement. And you will have access to a tool like this. You can also play around with it. But hope this session was very informative, and happy to answer any questions.